dot-com bubble burst.
Fannie Mae sees no end to housing boom.
Wall Street chaos. Lehman Brothers bankrupt. Bank of America buys Merrill.
Flash crash. Machines run amok.
10-year bull market. No end in sight.
Trade war escalates. Market sinks on fears.
Hello, and thank you for joining us for this episode of People and Money, where we discuss money and current events that influence financial markets both here and abroad. This episode of People and Money is brought to you by Ascensus. Ascensus is the largest independent record-keeping service provider, third-party administrator, and government savings facilitator in the United States. They aspire to make a difference and to help people save for what matters most: retirement, education, and healthcare. They have unparalleled insights into how millions are saving for the future, and their partners can help maximize success for their plan participants. Their proven combination of technology, expertise, and collaborative partnership helps individuals and families build greater confidence in their financial futures. Today, we welcome Jason Vaillancourt to this episode of People and Money. Jason is co-head of Global Asset Allocation at Putnam Investments. In partnership with other global asset co-heads, Jason is responsible for the overall strategy and positioning of Putnam's global asset products and the research that drives the top-down views of global asset portfolios at Putnam. Jason, welcome.
Thanks very much.
Jason, we have a lot to talk about today. Tariffs, trade war, slowing economy, and plummeting interest rates. You're particularly well positioned to speak about each of these topics, but before we get into the meat of the discussion, let's find out a little bit more about you. First of all, what attracted you to the investment management business? Was it your first choice?
It was my first choice, and so I'm one of those kind of few but possibly annoying people who kind of knew what they wanted to do with a high degree of certainty pretty early on. I was pretty good at math. I'd say pretty good isn't maybe an understatement. I was very good at math and all throughout high school. And it actually, interestingly, my varsity basketball coach in my high school was the economics teacher in my high school. And so as an elective junior year, in high school, I took his economics class and just kind of fell in love with economics and macroeconomics in particular. And there was obviously a lot of math involved, and it was something that kind of seemed to be a really interesting intersection between, what was going on in the world and financial markets and the stuff that I thought was good at and a career path that seemed pretty exciting. And so I basically kind of tilted everything towards that as I went forward from high school, and so sought out an undergrad degree that was very focused on finance and investments and economics. And basically kind of never looked back. And so that was basically my path from a very early stage.
So if you were scoring in double digits, then I assume you were getting good grades in economics from the same teacher.
I was, although maybe I was tall for my age at the time, so maybe more rebounds than points. But it was a good match. He was just a really good personality fit, kind of an irreverent guy. With a really good sense of humor, and made kind of a complex subject seem pretty fun, and it just happened to fit well with my skill set. So it was a really good fit, really good early entree into the business.
As you went through your undergraduate or your graduate classes at the University of Chicago, were you doing anything in the investment industry? Were you trading your own account?
So there was no, at the time, at least when I did my undergrad at Northeastern University here in Boston, there wasn't really a student-run fund at the time, but I was very, very focused on financial markets and kind of the quant side of financial markets. So I did a lot on econometrics, a lot on statistics, but not necessarily kind of running a portfolio. I was still kind of a poor college kid at the time, so didn't have a lot of free capital to invest. But I did at the University of Chicago, where I did the full-time MBA program. There was a student group basically centered around the buy side, and so did a lot of things on kind of digging into individual companies and some stock picking and the student-run fund there. And although my interest is obviously more kind of macro-oriented, but it was a really good intersection and way to interact with people who kind of at the time, in a lot of MBA programs, there's this kind of, at least there had been, a hyper focus on either investment banking or management consulting. And it was, the folks who had either come from the buy side or through the grad program or were looking to go into the buy side to make a career change. I think we're in on this kind of sneaky little secret about how much fun this business is, and kind of, had really kind of a work-life balance and a kind of a temperament that you don't necessarily find certainly in investment banking or management consulting, where there's such a focus on kind of immediate transaction oriented parts of the business. Whereas, I view asset management as being more about long-term investing and less about transactional orientation.
What was your first non-Wall Street job? Obviously, when you got out of the University of Chicago, it looks like you went to Fidelity and did some work there. But prior to that, anything interesting that you were doing?
Yeah, so I worked in investment grade corporate credit research at Fidelity before business school, before University of Chicago. So that was right after my undergrad experience at Northeastern. And one of the reasons I chose to go to Northeastern in the first place was there was a co-op program where it's actually a 5-year undergrad program, but you spend a good deal of time actually working for 6-month blocks during that 5 years. And so, you essentially kind of graduate from an undergrad program with a fair bit of work experience, which is a huge advantage.
Well, let's go into what you're doing right now. As co-head of global asset allocation at Putnam Investments, how are your decisions affecting your clients' investment strategies? Do you dictate how Putnam portfolio managers invest across multiple countries and sectors? Is your investment thesis distributed to individuals and institutional clients? How do you get the word out?
Yeah, so we manage the asset allocation team at Putnam directly manages portfolios. So we are the fiduciary and do the individual security selection for all of the strategies that we manage. Those portfolios include traditional long-only global balanced portfolios. So, traditional balanced portfolios, something like 60% stocks, 40% bonds. And we'll do not only setting the top-down asset allocation and the regional allocation, but also picking the individual securities that go into those top-down asset allocations. And we manage, those are kind of relatively plain vanilla portfolios all the way through something more sophisticated and more esoteric, which something like an absolute return oriented strategy, which is a little bit, frankly, like a kind of a hedge fund on training wheels. So kind of liquid alternatives that are more go anywhere, do anything oriented strategies and everything in between. Those global balance portfolios, the long only global balance portfolios, also are the building blocks for our life cycle strategies, our kind of target retirement date strategies for the defined contribution audience. So in your 401k, kind of a pre-diversified option. The reason that as a team, we philosophically believe it's really important for us to be the fiduciaries and do the individual security selection ourselves, as opposed to a fund of funds type strategy where we're just setting the asset allocation and then choosing someone else's building blocks, either Putnam's or external building blocks, is because, there's, if we're going to own those investment decisions, we need to make sure that every security that goes into those building blocks is kind of style pure and meets the criteria that we've set up as a team to make those building blocks what we think they're going to be. And so if we were, for example, to use either another Putnam fund or an ETF as the asset class building blocks, we don't have control over what those building blocks are going to look like. So if in that ETF or in that other Putnam fund, for example, there was a big departure in risk constraints, and so if there was a big sector bet on, or someone decided to take a beta bet, right, to kind of ramp up their exposure to the sensitivity to the stock market, we wouldn't obviously have control over those decisions. And so the reason that we pick all the securities ourselves is to make sure that we kind of know what the underlying risk characteristics of each and every building block is in those portfolios.
So your strategy is either good or bad, and everybody's going to know about it because you are vertically integrated from not only picking the strategy, the sectors, the assets, but you're also picking the individual securities that go into those building blocks.
That's exactly right. And the reality is we wanted to make sure that, if it goes right or if it goes wrong, we wanted it to be our decision, and we want to own that decision. And so we don't want to get the asset allocation right and then have the security selection be wrong if we're kind of outsourcing it. And so we want to make sure that we're kind of responsible for all of those decisions, both bottom up and top down.
Got it. Well, let's talk about some things that are going on right now. What's your view of the economy and corporate earnings in particular? Do you have any projections for either the rest of 2019 and possibly 2020, which is going to be a very big election year?
Yeah, absolutely. So we were when we had the sell-off in the fourth quarter of last year, 2018. We were very strongly in the camp that we were not going to see a recession in this year, in 2019. And so to the positions that we had on at the time going into the fourth quarter of 2018, we stuck with. And so we went into the quarter overweight equities, overweight commodities. And as we had the sell-off and the drawdown in the fourth quarter, the view was, look, this seems to be an overreaction. We don't see recession risk on the horizon. We're going to stick with those views. And, wouldn't you know it, subsequently throughout, at least the first part of 2019, all of those trades came back. So we got, like stocks came back to make new highs. Commodities didn't quite come back to the old highs, but we came pretty close. And so that was the right call. As we now progress through close to the halfway point of 2019, we've kind of downgraded our assessment of the economy. And so we wouldn't necessarily go out on a limb yet to say we're absolutely going to see a recession this year in 2019, but the odds of that have certainly gone up pretty dramatically just in the last couple of months. And so as we think through consensus forecasts for this year, Wall Street has consensus estimates for the next 12 months S&P 500 revenue growth of around 3% and earnings growth of around 6%. And then for the year out after that, looking for revenue growth of about a little over 4% and earnings growth of 10%. We think all of those numbers need to come down, for both the next 12 months and looking forward out from that, and that's mostly because of our downgraded assessment of the growth prospects of both the U.S. and the global economy. And that has a lot to do with a lot of what we've seen with regard to the trade war between the U.S. and China. It has a lot to do with corporate uncertainty, which had been pretty bullish story after the commodities recession in, call it 2015, 2016, where oil prices halved close to twice in that period of time. Oil prices got down to about $20 a barrel. In the recovery since then, through the end of last year, we saw pretty meaningful growth in capital expenditures on the part of U.S. corporates. That has really started to roll over and slow down to a trickle now, and we view the potential risk for escalation in the trade war between U.S. and China as being a material risk for a real slowdown in capital expenditures as we go through the next 12 months.
And yet the bond market has been forecasting, slow growth. I mean, I think the 10-year went from about 340 just a few months ago to now just slightly over 2%, like 2.1%. So do you anticipate that continuing?
So I think the folks who are, observing that there is this disconnect between the stock market and the bond market, I would take issue with that a little bit. I don't necessarily think they're giving conflicting messages. I think one of the reasons that long yields in the U.S., Treasury yields in the U.S. have had a ceiling on them and haven't really been able to rise and have actually come down a fair bit, just as you say, just in the last couple of months, has been the fact that Treasuries are now actually a high yielding asset if you look around the world, right? So if you kind of do the quick look through, United Kingdom government bonds yielding 80 basis points, German bunds, 10-year bunds yielding negative 22 basis points, Japanese government bonds yielding minus 13 basis points, right? So if you look around the G10, the major kind of developed world economies, U.S. Treasuries now actually look like a pretty high yielding asset. And so if you're a foreign investor in some of those countries, you can actually kind of go away from your local bond market, buy treasuries, hedge the currency, and actually generate more yield than you can in your own bond market. And so a lot of people have been doing that. And that's one of the reasons why there's been a massive flow of capital into U.S. treasuries, is because it's a relatively high yielding currency right now.
Yeah, and very safe as well. But that one of the big concerns that everybody always has is, well, the Chinese have $800 billion in U.S. Treasury bills and bonds, and if they get angry at us, they're going to sell them. Do you anticipate anything like that going on?
I don't. I think that would be kind of a classic cut off your nose to spite your face move, and so it is true that China actually has been cutting their holdings of treasuries for most of the past 6 to 12 months. It's come down quite a bit, but it's a fixed supply, so it has to go somewhere. They don't just sit out there. There's obviously a price finding mechanism, and treasuries are such a liquid market that I think if you look where treasury sales have been going to, think about regulatory environment that the world has been in the last several years since the financial crisis. Things like Basel III for banking regulations, right? So banks on their balance sheet are looking for assets that have a very low capital charge, and treasuries are obviously one of those things where that's one of the places where banks can park assets. There's another global regulation called Solvency II, which relates to global insurance companies, which is having the same effect and putting pressure on insurance companies to buy assets that have a relatively low risk weight. And so that's been another source for buying in treasuries. We've seen insurance companies in places like Japan and Taiwan, for example, be big buyers of treasuries in the last 2 years or so. So I think there's always, because it's such a liquid market, there is this supply and demand dynamic that has meant, even though China has been selling treasuries, there's always a place for it to go, and there's always a bid. And so, I think if that were a real threat, if Chinese liquidation of their treasury holdings were a real threat, when you think about what their alternatives are, right? They're looking at, like I said, you have to buy JGBs yielding, with negative yields, German government bonds with negative yields. So they really don't have a lot of options, and so that's one of the things that they're weighing. And the second thing that they're weighing is, is like if they do sell treasuries, if they bid down prices and yields go up, that's going to hurt their existing mark to market on their holdings. And so that doesn't feel to me like a credible weapon. And China has so many more weapons in their arsenal that it doesn't feel like that's the one that they would be most likely to wield.
Got it. People have made a ton of money in the stock market, not only through the first 2 years or 2.5 years, I should say, of the Trump administration, but also during the 8 years of the Obama administration. And one of the things people have done have invested very heavily into large technology companies, anywhere from Facebook to Amazon to Google, or just buying the QQQs out there and letting it ride. So moving forward, though, in 2019 and then 2020, you think it's going to be more of the same? Large tech stocks that brought us this far? Should we redeploy some money into some other sectors or some other countries?
I feel like that trade is still going to be the right one. And so I think it has less to do, it's certainly tech, but I think it has a lot more to do with the fact that what we would call platform companies or capital light companies have really been responsible for the bulk of the earnings growth in this recovery since the global financial crisis. And so if we think about earnings of capital intensive companies, so you think about energy companies, industrials, companies with big kind of property, plant, and equipment on their balance sheets, the earnings of those companies has been kind of dwarfed by the kind of earnings growth in these capital light businesses, so technology, biotech, right? So companies that are focused really on R&D and don't have kind of spending on things like research as opposed to spending on kind of equipments and plants. So with kind of long useful lives. And so I think that is a trend that I expect to continue, and that's where like margins have been the highest. That's where, as I said, earnings growth and revenues growth has been the highest. and I expect capital to continue to flow to those companies, and we expect earnings growth for those companies to continue to outpace the earnings growth in companies that are kind of have these capital intensive, these capital heavy businesses.
So you then have a large chunk of Putnam's money or Putnam's investors' money in large cap technology stocks still.
We do as a firm. We are exposed to tech for sure.
Okay, and you don't think President Trump's fairly explicit dislike of Silicon Valley and the regulations that he wants to put on those groups will have any negative effect on the growth of those stocks?
No, I do, and so I mean I think you have to disentangle the FANG companies from the rest of those capital light business models, and so as you said, FANG in terms of growth in market cap and appreciation of their stock prices has been a big story, but if you strip those companies out, where things like data privacy have been very big political hot button topics. It is still the case that even excluding those FANG companies, that earnings growth has been most powerful in these capital light businesses, and so I think there's a case to be made for tech ex FANG and for some of these capital light businesses ex FANG, and it is a fair criticism as you say that it is a very potent political and kind of on both sides of the aisle a political topic to talk about data privacy. Obviously, there's a lot of pressure on Congress to follow the European Global Data Privacy Directive that was enacted a couple of years ago, and I think the power of companies like Amazon and Facebook and Google in terms of the real underlying pressure that they have to prove to folks that they are doing something to protect people's data privacy is a real burden of proof and a real, as I said, a real hot button political topic. And I think that is fair, that those companies will continue to be under pressure on the political side for a while until, I don't know that we'll see an agreement on regulation anytime soon, but it certainly seems as though, both sides of the aisle are pressing towards that at some point in the future.
Let's talk a little bit about the offensive capabilities of this administration. In the past, many of our presidents and their administrations were either neutral or just played defensive, just tried to make sure things, make sure the trains ran on time. The other day I was in Washington, D.C. at a conference, and I was sitting in a bar called Thunderburger, which obviously they sold burgers. And I was sitting next to the Treasury Secretary, Steve Mnuchin. Now, he was far more interested in his IPA than he was in me, but I'm just curious as to your thoughts on how this administration's policy is driving the economy for either the good or the bad of the country. We're very offensive in just about everything we do. And do you feel that is having a positive or negative effect on where we're going?
Well, first, I'm happy to hear that the Treasury Secretary has good taste in beer and that he was not drinking Bud Light, some other kind of watered down swill that passes for beer in this country for the most part. But it is a shock to the system, certainly in terms of behavior. Look, I think the Trump administration views the American consumer as being a powerful weapon to wield, right? The threat of kind of closing off other countries' access to the American consumer is certainly a big threat and is a very powerful tool. And I think you should use it for good instead of evil. And you have to be careful in terms of how you use it, right? So I think this idea that you want to level the playing field in terms of trade is a valid idea, and I think that's fair. But there are mechanisms to deal with that outside of these threats that are very destabilizing to the global economy. So one of the alternative ways to deal with that threat would be to get the Europeans and the Australians and a lot of other emerging market countries on your side and take those appeals and those claims to the WTO and pursue those trade grievances through the normal course of action. And that's, that would have been one way to go. And it's not something previous administrations had really chosen to use as a weapon to wield, but it's there for the taking if that were the route. So I think the idea of opening multiple fronts in a trade war, I think takes away some of the threat of getting all your friends on your side and being able to kind of push these grievances through. Look, if you were the Chinese and you were now the second largest economy, you also have a big consumption market that you're wielding as a weapon, right? And so if you go to Coca-Cola and you say, look, if you want access to the Chinese market and you want to sell Coca-Cola here, this is what you have to do. You have to share with us. You have to set up a joint venture with a local company, and you have to share some of this technology secrets on how you get bottling throughput up so high. And if you choose not to do that, we'll just call Pepsi, and we'll see if they want to come play, right? And so if you're a big global multinational firm, and you want to do business in the Chinese market, this is what you have to do to play ball, right? So these are choices that companies make. So no one is really, if you want to choose to not share technology or choose to not do business through a joint venture, that's your prerogative. But that's a choice, and someone else might make that choice to do that. So I think if you look at markets after the Trump's election in 2016, we saw a big bump essentially all the way through the end of last year, the third quarter of last year, and a lot of that was on optimism around things like deregulation, corporate tax cuts, things that are very bullish for businesses. And so if you look, for example, at the NFIB, the National Federation of Independent Businesses, which is a trade group of small companies, kind of less than 1,000 employees in the U.S., that optimism index took off after the 2006 elections on hope of deregulation and tax cuts, and stayed at a very high level pretty much throughout until the end of last year, when we saw the opening salvos of some of these trade war issues. And now those indices have now started to roll over, and that optimism around tax cuts and deregulation has been replaced by uncertainty on trade. And so this is the biggest risk is that you've done enough damage to optimism that it's kind of irreversible at this point, right? So having this multiple front trade war is damaging business confidence. And so if you're a CFO here sitting in the United States and you're having to budget out over the next 5 to 10 years what you're going to spend on capital expenditures, you're thinking about building a new factory or hiring people, those are long-term decisions that have ramifications that can't easily be rolled back. And so if you're now met with this uncertainty, you are going to freeze and do nothing in that kind of with the scope of that indecision. And one of the things, as I said, is one of the reasons why we think now growth estimates and earnings estimates into next year need to be cut, is because that uncertainty is really going to flow through the income statement in the form of CapEx rolling over, or potentially in the form of hiring rolling over.
Yeah, in fact, I just saw something over this last weekend that stated that not only in the United States, but also throughout the world, there are now more people that are 64 years old and older, so either at or nearing retirement, than there are people 5 years and younger in the world. And so that means that we've got a ton of people who are relatively healthy because of medical technology and increases in our lifespan, and not enough people coming into the workforce that are going to be able to support those people.
That's exactly right. And I think a good place to look for what that might look like in the future would be Japan, where Japan's debt to GDP ratio is approaching something like 300%. And again, it's a market where interest rates have been pretty close to zero for a long time. And there's a question about the sustainability of that. But at some point, you do have to pay to service that debt stock. Yeah.
Well, hopefully my children are listening and they're going to take care of me. But anyway, I'd like to go back to China for a second. As you said, we've got the number 1 and number 2 economies in the world, and we're going 12 rounds in a heavyweight match and trying to win the championship with a knockout. But it seems to get worse every day. Who do you think is winning this trade war, and how do you think it's going to end? And long term, what effects is it going to have on our relationship, and what effects is it going to have on our economy?
So I think nobody is winning is the answer to the question. I mean, the reality is tariffs are a tax by another name, and so that tax either has to come out of demand destruction, right, or reduced consumption, or it has to come out of margins on the entities that are being tariffed/taxed. And so, I think as a weapon to wield, it is certainly a blunt instrument. But I think as we said earlier, what it does more is impart another level of uncertainty in terms of these relationships with our trading counterparties. So look, I mean, what everyone would love to have is every tariff around the world to go to zero, right? Complete free and fair trade with no tariffs, and I think until we get there, the Trump administration is going to use this kind of weapon and this kind of blunt instrument to try to force that equality. But as I said, it's a no-win situation because it is a tax in one form or another. Look, I mean, I think in terms of the bilateral trade agreement with China, it's pretty clear that anyone who kind of really understands the nuance and the intricacies of global capital accounting, if you read a textbook on it, it would certainly help you with your insomnia. But the bilateral trade in goods is not really the right metric. Because so much of what's gone on in the last 20 years has been about integrating global supply chains. And so services, the trade in global services is not really captured very well by those kind of national income and product accounts and those trade balance numbers. And the reality is, if you think about selling a U.S. car, for example, what you're counting is, when you sell the car in the U.S. is you have to also account for where all the stuff came from to put the car together. So it's not just the actual assembly of the car, but it's where the individual parts were all assembled, where the raw materials came from in the first place. Those numbers and those relationships aren't really well accounted for in the global trade balance data either. And so this idea that we've got this massive trade deficit with China is a little bit of a red herring, right? It's like it does not, you're looking at the wrong thing. And so I think again, it has to come, the effect of imposing tariffs has to come either through demand destruction because companies are going to pass on those higher prices to consumers, or it's going to come through lower margins. And I think both of those outcomes are detrimental for capital markets. They're detrimental for growth, and they're detrimental for probably stock prices as we think forward over the next 12 to 24 months.
So the statement that China is paying the tariffs is somewhat misleading.
It is. I mean, now look. I mean, so certainly the state-owned enterprises of a lot of Chinese companies are a big part of this, and so certainly there are companies that are owned by China, by the government, that have a stake in some of these relationships and make some of the things that we buy. But a lot of those are private enterprises as well, and both SOEs and private enterprises in China are involved in global supply chains, right? So they're taking DRAM coming from South Korea, they're taking microchips coming from Taiwan, assembling into an intermediate good and selling that to the U.S., which may put that into something else. And so this idea that kind of global companies are sourcing the individual building blocks of their products from lots of different places, that those trade relationships and those supply chains and that kind of just-in-time inventory system has taken 20 years to establish and get right. And you can't disentangle that in a quarter or even a year. Or like these are very painful things for companies to have to deal with over short windows, which is why you saw a big increase in inventories at the end of last year and in the first quarter of this year, as companies are just trying to front load the availability of all the parts and stuff that they have to build those intermediate goods. And that the effect of what happens with the next round of tariffs and that uncertainty really creates a lot of stresses for that global supply chain that are very intricate and involved, and I think difficult for markets to kind of unwind.
Do you think there's a possibility that the Trump administration is trying to, for lack of a better term, reorder those supply chains? We built them, as you said, over the last 20 years in China and a few other areas in Asia. And some in Mexico as well. But do you think that there's a possibility that President Trump and the rest of his administration want to bring those supply chains back to the United States and maybe the Americas and Canada?
I think that is a risk. And so I think as we were thinking through the state of play in the second half of last year, I think there was always this internal debate about, if you think about the classic, like sitting on your shoulder with the angel and the devil having a conversation in your ear, I think on one side you would certainly put someone like Peter Navarro and Steve Bannon having that conversation of these are national security threats and we have to bring all this manufacturing home, we have to make our own steel, those kind of real kind of nationalistic tendencies. And then on the other side, you had, a lot of the global free traders, the globalists, and so I think there was always the battle between these two forces of kind of who had the president's ear. And I think with what's gone on here just in the last month or two, you certainly have to at least increase the odds that it's been kind of the Bannon and Navarro faction of the White House, this kind of really nationalistic faction of the White House that is holding more sway. And I think that is certainly very disruptive and potentially, very dangerous for capital markets.
Take a look at the other side of the other pond in Europe, and it seems the Trump administration is just taking dead aim at the European automakers and what they're sending here. So BMW, Mercedes, even some of even Fiat are going to are being hit with tariffs. My family's from Detroit, but I drive a European and a Japanese car as well as an American car. How do you think the Europeans are going to react to this? And also the fact that they are becoming more nationalistic as well, with Brexit and some hardliners coming in various different countries throughout Europe. Do you think there could be a split between the continent and the United States?
There certainly could be, and that's one of the threats that's been made not so subtly at several points over the last kind of 6 months or so. And so, certainly that threat is on hold for the time being. But it's one that's been thrown out there. And so obviously, it's places like Germany and the Netherlands, where places like Volkswagen, as you said, Mercedes, BMW, a lot of industrial equipment manufacturers and engineering firms in Germany as well, are certainly big parts of those economies and big parts of those equity markets. And it certainly is it kind of falls into we're going to keep using tariffs and this threat as a stick, as a way to get what we want without really needing to offer a carrot on the other side. And that's, as I said, is at least been on hold for the interim. And I think part of that is, you don't want to open up too many fronts in a battle at the same time. You can only fight a war on so many fronts at the same time. And so that's been, I think, clever strategy, at least to hold off so far. But it's certainly an important threat and a big one if you're Germany and you're the northern part of Europe and the manufacturing base in Europe. And it's unclear where that will go. But it is, I think another weapon to say, look, if we need to have fair and balanced trade, and you need to open up your consumers to purchases of GM and Ford in the same way that people in the U.S. buy your cars. And so I think, hopefully, if the implicit goal is to get both sides to have zero tariffs and kind of have open markets for autos, then that I think would be relatively bullish, but it's going to be a bumpy path between here and there.
Finally, Mexico. Probably not President Trump's favorite country. Uh, do you think it's wise to be threatening tariffs, even though he suspended those tariffs just over the weekend, but threatening tariffs on Mexico, which is a huge producer of all kinds of automobile parts and other parts in industrial parts that are being shipped in the United States, on a daily basis. But to use tariffs to have Mexico squelch illegal immigration, is that a wise use of our time and our efforts?
That seems dangerous to me because, as you say, Canada and Mexico are our two closest and largest trade partners. You're trying to get this USMCA, U.S.-Mexico Canada Free Trade Agreement signed and ratified by all three countries' respective governing bodies. And so to do this and lob this kind of grenade into that conversation in the middle of getting USMCA ratified everywhere is certainly a risky gambit, and certainly I think is another source of uncertainty to link an economic weapon to what's really kind of a political goal or an end. And so I think that's a big part of the reason why equities sold off pretty hard when that was first wielded as a threat, and a big part of the reason why equities have kind of rallied so much now that the threat has receded over the course of the weekend. But it is, as you say, the trade, between U.S., Mexico, and Canada and Mexico, and Canada and the U.S., that trilateral agreement is a big part of that is driven by autos, and so that people who kind of follow that supply chain will say that some U.S. auto parts and pieces cross all three of those borders in as many as 8 times in the kind of manufacturing of an auto.
It does seem like we're treating everybody equally. We hate our friends just as much as we hate our enemies, and I think we have enough enemies that are out there. But let me ask you specifically, is there anything you're doing based upon some of the things that we've talked about? Is there anything you're doing with your portfolios where you are hedging your bets about huge losses that could be coming because of these, the trade frictions that we have?
Well, one of the things that we've done is, as I said, we actually have we've cut our asset allocation risk in general, and so we've decreased our equity overweight all the way back to neutral. We had been overweight commodities, as I said, towards the end of last year. We've taken that all the way back to neutral as well, and so we've substantially cut what we call our tactical asset allocation risk, or our dynamic allocation risk in the portfolios, directly as a result of what we see as the potential for all of this trade friction and all of this uncertainty on the part of the corporate sector to lead to a pretty dramatic slowdown in earnings throughout the course of this year into the early part of next year.
Do you think it'll be, the growth story will end with a bang, or will it end with a whimper and just a continuous decline in interest rates and a continuous decline in stock prices?
I think it's more likely to be a whimper than a bang. But one of the things that we believe pretty strongly in is that volatility, as measured by something like the VIX, for example, should be higher than what it is right now. And so we do expect also an increase in volatility in general. And we've certainly seen the volatility of volatility rise just in the last 6 months, and that sounds like a weird thing to say, but when you think about the VIX or the standard deviations of moves in stock prices, we've had episodic spikes in that volatility. And so you think about the fourth quarter of last year, and you think about what went on, for example, in May of this year. You've seen these episodic spikes, and we think that's going to be more normal.
A lot of us think of volatility as when our stock portfolios go down. We always consider ourselves smart investors that are growth oriented when the markets are going up. But I digress. Anyway, in previous conversations you and I have had, you had some pretty strong opinions on the American education system, and in particular how it fails to prepare students for our ever-changing economy. Can you share some of your thoughts?
Yeah, so I think, it really struck me after the global financial crisis in 2008 that, a lot of states, as a result of that, that you saw obviously a big spike in unemployment claims. A lot of states were, viewed that drain on their kind of fiscal balances as being unsustainable, and so some states moved to essentially kind of really limit the number of weeks that folks could be on unemployment insurance, so the duration of time, and also the kind of the total sum benefits that you could withdraw from the system. And so it's really kind of decreased the safety net for the next crisis as a result of some of these changes at the states level. But the problem with that is there was not a corresponding change to the way that we prepare people for these big frictions of essentially kind of lack of skills training for the jobs that are being created. And so you think about, we talked obviously about how manufacturing has moved and outside the U.S. And a big part of the Trump message was, we're going to bring a lot of these jobs back. But I think the what you miss from that is the displacement of those jobs, those kinds of jobs that historically have been a big part of the U.S. manufacturing base, are not so much about outsourcing. Has a lot more to do with technology and automation changes. And it's really easy scapegoat to blame China and blame Mexico for taking U.S. jobs, but it really has a lot more to do with automation and the advent of technology into a lot of these kinds of businesses. And so we've always kind of thought, and I've personally always thought, that the U.S. doesn't really. It's a big country, and I get that there's obviously challenges here, but if you're going to take away that safety net in terms of unemployment insurance, you need to at least provide something in terms of job training for those folks who have been displaced by automation and technology, and kind of prepare them for the jobs that are going to be created, right? So if you were, you didn't know Netflix was going to come around, 10 or 15 years ago, and you happen to be, or streaming, and you happen to be working at a Blockbuster Video, what are you going to do for a job if you own a bunch of Blockbuster chains, or you spent your day rewinding VHS tapes? I saw there was a really good TED Talk in 2006 by a guy by the name of Sir Ken Robinson, who teaches education, and he really talked about our essentially kind of whole Anglo-Saxon school system really started at the beginning of the 19th century, at the dawn of the Industrial Revolution, with the entire aim to get people into universities and colleges. And then the entire curriculum in those university and colleges essentially to kind of prepare people for, being a teacher or professor, and to basically kind of make education as the end in and of itself. And so, a lot of folks in tech in the last kind of 5 or so years have done things like offering prizes to people who are, basically kind of, don't go into college, come and work in our think tank, or come and work in our incubator, and help us come up with some solutions for these, creative technology issues. I think that's a really innovative technique as a way to get people involved in tech, without necessarily going through a traditional liberal arts education. Not that there's anything wrong with a liberal arts education, but when you think about where the jobs are going to be, and where it's an appropriate analogy given the Bruins win last night in Game 6 of the Stanley Cup playoffs, but think about where the puck is going to go and where it's going to be, and not where it just came from. And so, we really don't do a good job as a country and as a system of preparing folks for the evolution of where the jobs are going to be over the next kind of 5 to 10 years. And so that's something where I think, the country as a whole needs to do a better job. And we'll see if that becomes a political issue in the 2020 elections.
It's interesting. When I was a kid in Detroit, and that goes back a ways, literally somebody could graduate from high school on a Friday and report to the River Rouge plant on a Monday and work there for the next 30 years, and then retire with a pension, and they would have a second home in the Upper Peninsula of Michigan. That's not true anymore. And in fact, I saw recently that there are over 2 million jobs that are out there that require technical education, and that's just running machines in factories and doing some other things that high school graduate could do if they were trained properly.
Exactly. And I have the same experience. I grew up in a small town in northern New Hampshire, less than an hour from the Canadian border, where the biggest employer for 80 years was a paper mill. And that eventually that paper mill became kind of obsolete and outdated, and all of those jobs kind of went away. And so, that's it. But when you think about what the next 20 years are going to look like, I just had a personal experience this week where I was trying to make an appointment to get a checkup with a dermatologist, and the dermatologist here and my healthcare provider in Boston is booking out to October. And so again, we talked about baby boomers, we talked about the aging of the U.S. population, healthcare and taking care of those folks who are going to be into their 80s, pretty soon is a job that's going to require, you don't necessarily need to go to a traditional university for that. You can go through a nursing program, you can go through a physician's assistant program without necessarily going to med school and, kind of a radiology tech, those kinds of folks. There's going to be a big need for that in 10 and 20 years from now as the U.S. population continues to age.
Yeah, I just went to a dermatologist. Unfortunately, I was able to get an appointment, and she cut me up pretty badly. So she said to stay out of the sun and wear a hat.
Yes, always.
Exactly. Again, one of the other things that we talked about recently was private equity and the bubble that is out there that worries you a little bit. You want to talk a little bit about that? Because for one thing, there's plenty of jobs, or at least everybody seems to be in private equity. And they are everywhere. They're looking for the next opportunity, especially in the financial services area, mutual fund companies, registered investment advisory firms, record keepers, you name it. They're getting bought up by private equity people. You want to comment a little bit on that?
Yeah, absolutely. And I would say we were having the same conversation today about private equity firms buying up the practices of dentists and dermatologists as well. So it kind of full circle. But one of our views has been that this idea of pushing private equity into traditional portfolios and portfolios of kind of mainstream investors is a little bit of a dangerous game, just because it forgets the fact that the word equity is already in private equity. And so, most people's traditional balanced portfolio has something that looks like a 60% allocation to equities and a 40% allocation to fixed income, maybe a little bit of other stuff in there. But that's, for the most part, what people's retirement portfolio looks like outside of their home in terms of investable assets. Private equity is equity. And so, a lot of people forget that. And I think, for us, it's that what the real trick of private equity comes from what we call return smoothing. And so, when you're getting your statement from your private equity investment, you're getting it once a quarter, and the NAV, or the net asset value of the holdings of that private equity fund or strategy, is essentially whatever the manager tells you it is. There's no mark to market. If you get an environment where you get another 2008, the companies they can't sell them, so they're basically just guessing what those companies are worth and what the NAV is. And that's always struck us as a little bit of an unfair comparison relative to the more liquid parts in your portfolio. So private equity firms will typically report to you a metric that they call IRR, or internal rate of return, which reflects the fact that when you make a capital commitment to private equity, for every $100 that you commit to a private equity fund, they're going to only call a certain portion of that every year, and that may go on. They may call $10 of that next year, and 5 of it the year after that, and 10 of it the year after that. That internal rate of return, or that IRR calculation, assumes that you're earning something like a money market type return on the portion that's not been invested. But there's an opportunity cost to that, which is not reflected in that metric of IRR, which is what's the other stuff that you could have been doing with the rest of your $100 while it was not being called. We've done some work, for example, that looks at a more comparable return series to private equity. There's a handful of firms that track private equity investing. State Street did it for a little bit. Preqin does it as well. Where if you look, for example, think about what a private equity company is doing. They're looking for cheap assets to buy that they can apply some leverage to. And so, if, for example, if you look in the U.S. at mid-cap companies, if liquid mid-cap companies, and you take a subset of those companies, let's say the S&P 600, mid-cap index, if you take a subset of those companies that screen as being cheap, and then you basically think about where private equity companies prefer not to play, so that private equity companies don't usually play in financials, they don't usually play in utilities. So you think about your classic kind of industrial business where they're kind of under levered and they're cheap assets. If you take those public companies where the stocks are traded every day, they're marked to market every day, you take that subset of companies that's relatively cheap and under levered, and you apply some leverage to that, and you only mark them to market once a quarter. The reality is you can get pretty close to the risk adjusted return that you would see on those private equity holdings. And so, I think this idea that, you're not really making an apples to apples comparison with this IRR metric is really elusive and confusing to some folks who might be thinking about or might be getting talked into private equity where they don't necessarily understand exactly what they're getting. And so I think this idea of smoothing of returns because they're not marked to market every day like public markets are, and this idea that they don't take the money all at once, and there's an opportunity cost to that. I think those are a couple of the least well understood aspect of private equity investing that I think don't necessarily mean it's a completely appropriate thing for individuals to be invested in.
So you also think that it seems to me that they play the greater fool theory. I'm going to buy something which I think is cheap, and I'm going to apply leverage to it, and then I'm going to hope somebody takes me out at a much higher price down the road, and I can pay off all my leverage. Yeah,
and I think there's plenty of academic evidence and literature to suggest that this idea that they're taking mismanaged companies or kind of inefficiently managed companies and making them better and more fundamentally sound businesses doesn't really hold up to empirical scrutiny in a lot of the academic literature. So I think, again, it is the bulk of what you're getting, the bulk of the benefit is, kind of looking for cheap stuff and applying some leverage to it. And that's really, essentially what you're buying. And there's no reason to believe that you can't necessarily do that in public markets as long as you kind of don't look at your statement every day.
Finally, well, not finally, but one other question. Everyone is always concerned about a possible recession. Everybody's concerned about the market, pulling another Q4 of 2018. In your mind, are there 3 or 4 trigger points that you think would lead to a recession, and if so, what are they?
So certainly, as we've talked about, the idea that the erosion of corporate confidence and corporate animal spirits would be one of those things in response to trade wars and uncertainty about the stability of your supply chain. There's a handful of things that we're keeping an eye on to track that. We watch very closely shipping data out of the major ports. We watch very closely exports in some of the more technology sensitive export markets like a Taiwan or like a South Korea, for example, to look and see how China is developing, right? Because obviously the economic statistics in China tend to be smooth, and they tend to not necessarily always be completely reliable. But the things that we can count and can measure in real time, like exports from South Korea, for example, is one of those things that is giving us a good read on the direction of the global economy. And then the way that we track corporate confidence would be twofold. One of those things would be through this NFIB optimism survey and CapEx plans survey conducted by the National Federation of Independent Business, kind of keeping track of small business sentiment. And then the second thing would be just actual CapEx, capital expenditures in the quarterly earnings data to see, for example, how in the S&P 500 and the Russell 1000, big U.S. multinational companies are evolving in terms of their CapEx plans, because as I said, that is one of the things that CapEx growth has been one of the things that's driven earnings growth and has driven stock prices really through most of the last 24 months.
And right now, you don't see too many negatives out there.
We see a leveling off in what looked like a pretty good growth story, as I said, from call it late 2016 or the second half of 2016 up through the third quarter of last year, we've seen all of those metrics start to roll over and flatten out. They haven't quite taken a meaningful enough deterioration yet for us to really sound the alarm on recession risk. But again, I think all of these things, the trade war rhetoric, the threats of tariffs with Mexico, the run up to the G20 meeting where Trump and Xi are supposed to get together, all of these things are kind of happening in real time, and so those are the signposts and the metrics that we're keeping the closest eye on for a real time read on corporate confidence and the pace at which it is deteriorating.
Got it. Now we'd like to play what we call our speed round. I'll ask you a few quick questions about you and your past, and hopefully neither one of us will be embarrassed by your answers. You've been doing this for about, 20 years now?
Correct.
So what's an event during that 20 years that surprised you as well as everyone else? Something you really weren't looking for that had either a massive positive or negative effect?
So I would say probably the Fed's letting Lehman go in 2008 would be one of those things. It felt like a very big miscalculation after stepping in on the part of Bear Stearns, and then after stepping in with AIG and the autos. Like if we're gonna do a bunch of bailouts and apply them kind of willy nilly. And let this one go where there's a lot of leverage and we didn't like what the underlying book looked like. That seemed to me to be if you had a mulligan or a do-over, that's potentially the one thing where if you could have stepped in and saved Lehman, you might have saved a bunch of other pain further down the road in the fall of 2008.
And you don't see toxic assets, an accumulation of toxic assets out there like we did in 2008?
I don't. That's one of the things we struggle with in terms of thinking through recession is, I think one of the things you need is real evidence of kind of malinvestment or kind of true misallocation of capital. And so if you look, the financials were levered, in some cases 15 times in some of the big investment banks. The famous comments on the part of Bernanke with respect to subprime mortgages that the problem was well contained, prior to the financial crisis. There's whether it be housing in 2006, 7, and 8, or whether it be the tech bubble in kind of 99 into early 2000, we just don't see real it's kind of sizable as a meaningful percent of GDP misallocations of capital or signs of malinvestment in the U.S. right now. So that's one of the reasons why I think it's a lot harder to make the case for recession now without those kind of clear warning signs. That there's just kind of, we like to, and as I said, in my former life, I was a credit analyst, and I just like to call that stupid lending. We just don't see real signs of kind of stupid lending right now.
That's probably why I can't get a loan at the bank. Now, do you have a story when you swam against the current and you were right and everybody else was wrong?
Well, let's see. I bought Bitcoin at 8,000, so I can't say yet whether or not that was the right call. And I think we won't know maybe for another couple of years. But I think we're getting to the point where we've had the shakeout of some of the sketchier digital currencies. But I think we're getting closer and closer to the point where we've got a futures contract. We've got Fidelity is obviously stepping up the custody. Building out a custody business for Bitcoin. And I think when we get to the point where you're able to pay for stuff with your Bitcoin, then I think it'll have a real kind of network effect and first mover advantage. And the fact that it's kind of limited in terms of the number of them, unlike fiat currency, I think and unlike gold and precious metals, I think is one of its benefits. And I can't say yet. I bought it at 8,000. It went to 11 or 12 or something, and then back down to 4. And so but it's now back over 8,000. It's back over in my cost basis again, but I won't really be able to say for sure for probably another year or two.
Yeah, it is. Buying into a bubble is a pretty cool experience. You don't know exactly when it's going to burst.
Exactly.
Or if you're buying it, has it already burst and I didn't know about it?
Yes, having not really participated with any meaningful amount of leverage in either the tech bubble or the real estate bubble, I vowed to, one of these days I'm going to be in a bubble and benefit from it. And so this is my gambit to try to benefit from a bubble.
What was your best investment decision?
I would say probably, honestly, buying a house. I think like this kind of, there's a generational shift away from wanting to own your own home and towards renting now, and so millennials obviously are kind of more inclined to rent versus buy. But we honestly, as far as personal capital goes, I think we bought our first place in the city of Boston in 1994 in the South End for what at the time seemed like an astronomically exorbitant price. And I wish I had bought the entire block, knowing obviously what I know now. But Boston as a place has really flourished. It's one of the handful of states in the union that's got population growth, and it's benefiting from obviously the explosion in biotech and healthcare and technology and education. And it's like it's been a really great place. It hasn't seen quite the skyrocketing in our appreciation of a place like San Francisco and Silicon Valley. But I think as a hub of activity, it's certainly been one of the better places to have ended up in owning real estate.
It is a great town. On a personal note, what do you like to read?
So I kind of like, I'm an escapist, and so like I don't want to go to the movies to see something that's like horribly depressing. Sitting looking at the Bloomberg screens all day. So I like for a little bit of escape in my reading. I tend to favor nonfiction, and so I've loved all the Michael Lewis books. I've loved all the Ben Mesrick books. And I think they're kind of interesting economic stories that usually have some geekiness to them. So I think of Moneyball, right, as being a great example of that, where it's like I'm a Boston sports nut through and through. And so, like the idea of kind of mixing in baseball and quantitative research and empirical research into one thing is right up my alley. I just got back from a very long kind of 2-week trip to Asia for work, meeting with some of our clients and some of the bigger, sovereign wealth funds and government funds in Asia. And so that was, I've spent something like 56 hours on planes over the course of 2 weeks. So I just reread Anthony Bourdain's first book, Kitchen Confidential.
Oh yeah, love
like
that.
One of the classics, and I think it's like a really good read. And it's very sad that he's no longer around to entertain us.
That is true. So when you're not making global macro investment decisions involving billions of dollars, what do you like to do with your time?
So as I said, Boston sports junkie through and through, and so these stupid playoff games go so late at night has kept me bleary-eyed in the mornings. My wife and I like to travel extensively, eat and drink, and kind of see the world through food and wine, and we play a ton of golf, and that's only been possible here in this horrible climate that we live in New England for really about the last couple of weeks. But we're finally starting to make our way into summer. I think this past weekend, we had 2 days in a row where there wasn't a cloud within 100 miles, and it was, kind of perfect, basically indoor temperature outside for 2 straight days. So it's kind of a perfect 10. So we're kind of getting into the sweet spot of summer now.
Yeah, the Northeast, it's glorious when it's beautiful, but it's not beautiful often enough.
Exactly.
And the last question. If I were a first-time investor with $10,000 and I worked hard to get this $10,000,
mm-hmm.
How would you have me invest it? And remember, I want to make a lot of coin on this trade.
Sure. Well, I would say first that as far as talking to an asset allocation team and a multi-asset investor, that's not the place you go to make coin and swing for the fences. So people come to us and people trust us with their money, generally because they want us to keep them from getting poor. They've already accumulated wealth, and you come to us to keep it. And so, I would say, look, diversification still works. There was a time in the mid 2000s. There was a few years where stocks, basically large cap U.S. equities, were the only thing that made you money. And that was true for maybe 2.5 years, a couple years ago. But it is the case that now we're starting to see diversification work again. So stocks and bonds continue to be negatively correlated. So there's been a benefit to holding both in your portfolio. The same has been true for a small allocation to commodities. So commodities, especially something like a light energy exposure to commodities, where there's a better risk balance between things like energy and industrial metals and things like agriculture and livestock and precious metals. That has been a benefit to portfolios as well. So I would say it's a boring answer, but this is what we do, which is a diversified portfolio that gives you kind of a lot of ways to win, and it gives you something that's got some protection in there from big drawdowns and risky assets. Continues to, in our view, continues to be the best way to save capital.
Got it. Is there any particular, right now, is there any particular sector or country or region that you think is going to outperform the others?
So we talked a little bit about those capital light business models, and we think that's, especially in the U.S., that's where earnings will continue to come from and continue to be driven by. We favor the U.S. as a region right now relative to global equity markets. We view emerging markets as not as attractive as some folks who are kind of attracted to EM based on value. So value is one of those tricky things, which is works long term, but it's a terrible timing indicator. And so a lot of big, really kind of deep value investors have been attracted to EM over the past few years and have gotten their faces ripped off by it. And so we continue to view U.S. as being the most favorable equity market. And I would say that continues to be true. And as far as sector positioning goes, in addition to some of those capital light business models, we actually favor energy companies as a sector right now. We think that they've underperformed pretty meaningfully, both relative to the equity market and relative to commodity prices. And that tends to be mean reverting over time. And so that's kind of the one sector where we feel like we've got a pretty meaningful tilt right now is towards energy, the stocks of energy companies that have underperformed both the commodity and the stock market.
Jason, great call on energy. With tensions rising in the Strait of Hormuz and Iranians apparently trying to sink shipping and shoot down our drones, oil and gas prices are going to go through the roof. Jason, I want to thank you for your time and your insight, and I want to thank you for joining us on People and Money. And once again, I'd like to thank our sponsor, Ascensus. At Ascensus, they aspire to make a difference and to help people save for what matters most: retirement, education, and healthcare. Their proven combination of technology, expertise, and collaborative partnership helps individuals and families build greater confidence in their financial futures. For more People and Money, be sure to subscribe on YouTube at people.and.money. Follow us on LinkedIn, Instagram, Facebook, and Twitter. We want to hear from you. Tell us who you'd like to hear on People and Money by leaving a comment. This is your host, Jeff K. James, signing off.